Welcome to today's deep dive. I'm your host, and we are so thrilled to have you with us today.
Yeah, glad you're here. We've got a really wild one today.
We really do. We are unpacking a case study that sits at this incredibly unusual intersection. It's right between high-stakes financial valuation and the very raw biological reality of human organ transplants.
Right, which is not a combo you see every day.
No, not at all. We are looking at TransMedics Group. Ticker symbol is TMDX. And the reason we pulled this specific company out of the research stack for you today is because of this stark duality it presents.
It's like two different stories.
Exactly. On the clinical side, you're looking at a medical marvel. Technology that is fundamentally altering the paradigm of life and death for patients waiting on a transplant list.
And then on the financial side.
On the financial side, you are looking at a stock chart that would literally give a day trader vertigo.
I mean, it is notoriously volatile. Just to give you a sense of where it currently stands, the stock is sitting at $129.30. And that comes right after a recent daily drop of almost 8%.
8% in a day.
Right. Yet, if you just widen the lens to the past year, it's still up 104%.
Which is massive.
Yeah.
And if you stretch that timeline all the way back to their IPO in 2019, TransMedics is an 8-bagger.
Yep.
It has multiplied in value 8 times over. It's currently holding a $4.4 billion market cap.
Yeah.
So you've got this biotech firm achieving medical miracles, but at the same time, it's this massive battleground for bulls and short sellers.
A total tug of war.
So to synthesize what is actually happening beneath all that noise, we're going to run the data through a very specific analytical framework for you today.
The Motley Fool framework.
Right. The Motley Fool co-founder David Gardner's 6 traits of a rule breaker stock. For anyone analyzing their own portfolio, this framework is basically designed to filter out the static and identify companies that are structurally poised to completely disrupt their industries.
It's a great lens for this.
Okay, let's unpack this. How exactly is a $4.4 billion company literally keeping organs alive outside the body? Because to understand the financials, you really have to understand the biological problem first. Let's talk about the old way.
Right, the ice coolers.
Yes. For decades, the standard way to transport a donated organ was essentially putting it in a glorified igloo cooler.
Yeah, the medical term is cold ischemia.
Right.
When an organ is retrieved, they flush it with a preservation solution and throw it on ice. The whole goal is to drop the temperature to slow down cellular metabolism.
Which theoretically buys you time.
Theoretically, yes. It buys the surgical team time to transport the organ.
But slowing it down doesn't stop the damage, right? The clock starts ticking the exact second that organ loses its blood supply. You only have a few hours, especially for something like a heart or a lung.
Oh, absolutely.
You are basically in a desperate race against ischemic injury, which is why TransMedics came up with the Organ Care System, or OCS. It's this next-gen array of solutions that doesn't just freeze the organ, it replicates the natural living environment outside the human body.
It's warm perfusion instead of cold storage.
Yes, warm, oxygenated blood pumping through it. The heart is literally beating in a box on an airplane. The lungs are breathing, the liver is producing bile.
It's incredible. And what's fascinating here is how the utilization data actually exposes the deep, deep flaws of that traditional cold storage method.
Lay the numbers on us.
Well, you'd assume, because transplants have been happening for decades, that the ice cooler system was relatively efficient. But the statistics from the sources paint a much grimmer reality. Under the traditional ice storage method, only 20% of donated hearts in the U.S. actually make it into a recipient.
Only 20%?
Yes. The remaining 80% go to waste. For lungs, the utilization rate is just 24%. Livers are a bit better, sitting at 61%.
That is just a staggering inefficiency, especially in a system where patients are routinely dying while waiting for a match.
Exactly.
And I think that really neatly brings us to the first trait of the rule breaker framework, which is being the top dog and first mover in an important emerging industry.
Which TransMedics definitely is. They hold roughly a 20% market share in U.S. transplants for those 3 major organs right now.
But it's that emerging industry piece that I want to highlight.
Right, because they aren't just taking a slice of the existing pie. They are actively expanding the total pool of viable organs. This shows up most clearly in a category called DCD.
Donation after circulatory death.
Exactly. Historically, surgeons really preferred organs from patients who suffered brain death because those organs were kept fully oxygenated by ventilators right up until the surgery.
But with DCD?
With DCD, the heart stops. The organs suffer a period of warm ischemic injury before they can even be put on ice, and cold storage just couldn't salvage them. They were too stressed.
But because the TransMedics OCS immediately supplies warm blood, it can literally resuscitate and assess those DCD organs. And the data here is wild. Since 2017, the utilization of organs from circulatory death donations has jumped sixfold,
600%.
just because the preservation technology changed.
It essentially turned a stagnant medical market into a high-growth, emerging one.
Here's where it gets really interesting, though. Because building a box that keeps a heart beating in transit is obviously a massive medical achievement.
A miracle, really.
Yeah, and for most biotech companies, that would be the entire business plan, right? Make the machine, sell the single-use tubes to the hospital, collect your revenue. But TransMedics realized the hardware was only half the battle. They aren't just a medical device company. They operate a massive logistics network.
Right, the National OCS Program, the NOP.
Tell us about the NOP.
Well, they realized that regional hospitals just do not have the specialized staff waiting around to jump on a private jet at 2 a.m., retrieve an organ, and run a highly complex warm perfusion machine through heavy turbulence.
The logistics were completely bottlenecking the science.
Exactly. So they made this pivot, which aligns perfectly with the second rule breaker trait, creating a sustainable competitive advantage. They brought the entire logistical operation in-house.
They bought their own planes. According to the research, they now operate an aviation fleet of 22 aircraft and 18 hubs across the U.S.
They literally built an airline.
An emergency medical airline.
It is the ultimate economic moat. We are talking about true end-to-end vertical integration, from R&D on the perfusion devices all the way to the pilots flying the actual organs.
Which is incredibly hard to replicate.
Think about what a competitor would have to do to catch up today. You can't just build a better medical box anymore. You have to acquire a nationwide fleet of jets, get FAA approvals, and staff 18 hubs with clinical specialists. It's an almost insurmountable barrier to entry.
Which naturally leads us to the price tag of building an airline. Let's look at the third rule breaker trait, strong past price appreciation, and we'll pair that with the sixth trait, which is being called overvalued by the financial media.
The growth metrics are definitely there to support trait 3.
Yeah, 32% sales growth in the latest quarter alone. And the stock keeps hitting new highs despite the volatility. Past price appreciation is actually a great way to find promising growth stocks. Winners tend to keep winning.
But that growth comes with a hefty premium, which brings us to trait 6.
The overvalued argument.
Right. If you look at the bearish arguments, TransMedics trades at 56 times forward earnings.
56.
Yeah. They even faced a targeted short report in early 2025. And even though the stock has doubled since that report came out, a massive 25% of its float is still held short today.
25% short interest is a huge red flag for a traditional value investor. That means a quarter of the shares are actively being bet against by people who think this thing is going to crash.
And you can see why they think that. Airlines are famously capital intensive. You've got fuel costs, pilot shortages, massive maintenance bills. You bolt an airline onto a biotech firm and the cash burn risk skyrockets.
But the rule breaker perspective shifts that entirely, right? The counter argument is that this premium valuation isn't a bug, it's a feature.
Exactly. Traditional metrics like PE ratios are blind to the creation of entirely new markets.
Right, like we said earlier. Expanding the market by 600% for DCD organs. Just to give you all a broader market context from the sources here, it's a fascinating contrast to the AI boom right now.
Oh, the AI comparison is perfect.
The whole financial media is completely obsessed with finding the next indispensable monopoly powering NVIDIA or AMD. They want the world's first AI trillionaire.
For scalability.
Exactly.
Yeah.
Meanwhile, you've got this biotech company, TransMedics, quietly cornering a life-saving physical monopoly in the background. But because it involves jet fuel and human biology instead of microchips, the market is totally divided on it.
And that physical operational risk really brings us to the human element, which touches on the fourth rule breaker trait, good management and smart backing.
Which they have. TransMedics is founder-led. The CEO, Dr. Waleed Hassanein, has been working on this exact problem since the early 1990s at Georgetown University.
He saw the ice coolers failing firsthand.
Right. So, what does this all mean? We have a visionary founder, a massive logistical moat, incredible sales growth, and they are literally saving lives. Well, I have to play the voice of reason here.
Please do.
There are caveats. Our sources highlight 3 very specific red flags for you to consider. First, despite dedicating his life to this, the CEO only owns about 2% of the outstanding shares.
Only 2%, which is really low for a founder-led growth story.
Right. You usually want high insider ownership. But the next two red flags are about the company culture. TransMedics has a weak 3.2-star rating on Comparably.
Ouch.
And only 44% of employees approve of the CEO.
Less than half.
This raises an important question about how hypergrowth and intense logistics might be straining the company culture. It's easy to write off employee reviews, but when your business is an around-the-clock emergency medical airline,
Exactly.
you are dealing with life-and-death stakes, crazy hours, and relentless pressure. If your highly trained clinical flight specialists are burning out, your logistical moat starts to crack.
High turnover means execution failures. And an execution failure here means an organ doesn't make it.
Which is terrifying. But despite those internal culture scores, we have to talk about the fifth trait, strong consumer appeal.
Which is an interesting one for a medical device company.
Right, because there's no traditional consumer brand appeal. You aren't buying an OCS machine for your kitchen. But there is this undeniable greater good here.
Oh, absolutely.
Disrupting ice storage to save lives, streamlining the chaotic process for hospitals, it makes it incredibly hard to root against their success.
The clinical imperative is a huge tailwind. But looking to the future, what could actually allow them to outgrow that expensive 56 times forward earnings price tag?
What are the catalysts?
Well, they are building out the national OCS program in Italy, so expanding internationally. They are testing next-gen OCS devices for hearts and lungs. But the big one
The really big one.
is launching OCS clinical trials for kidneys.
Which changes everything. Kidneys are the most transplanted organ in the world by a mile. If they can apply this network to kidneys, the revenue potential is astronomical.
It totally dwarfs hearts, lungs, and livers combined. But as a transparent disclaimer from the sources,
Yard point.
despite all this potential, TransMedics was actually not chosen in the Motley Fool Stock Advisor team's recent top 10 list of stocks to buy now for monster return.
Right. Which just reminds you that investing always has multiple perspectives. A company can be doing world-changing work, but still carry too much execution risk, or just be priced too high for a specific strategy right now. So let's summarize this for you. Today, we looked at a company that is vertically integrating organ transplants. They command a massive premium in the market. They're heavily shorted. Yet, fundamentally, they are changing the math on how many human lives are saved.
And understanding why this matters is so crucial. It's really a masterclass in how true innovation often looks completely overvalued in the short term.
Because it doesn't fit the old spreadsheet models.
Right. And it shows why a wide moat, like an actual aviation fleet paired with medical tech, is so critical for long-term growth.
It's physical infrastructure meeting biology.
Exactly. And I want to leave you with a final thought to mull over based on the data we saw today. We noted that simply by changing the preservation and logistics technology, the utilization of organs donated after circulatory death jumped sixfold.
600%.
Right. So if applying advanced supply chain logistics and environmental replication can unlock a 600% increase in a biological resource we were previously just letting go to waste, what other massive, seemingly fixed limitations in human healthcare are actually just waiting for a better transportation network?
Wow. That is such a fantastic point to end on. It's not always just about finding a new drug in a lab. Sometimes it's literally just about building a better delivery route. Well, thank you so much for joining us on this deep dive. We hope this gave you some incredible new insights to explore. Keep questioning the consensus, and we will see you next time.